Hello, my name is Kurt, and I'm a value investor. And today I'm going to do a stock analysis and discounted cash flow valuation of the LKQ Corporation, ticker symbol LKQ. For anyone who's new to the channel, consider subscribing so that you can continue to watch these stock valuation videos and my investing journey as I use value investing principles. So let's get into the presentation and look at LKQ. So here's my presentation for LKQ Corporation, the stock valuation discounted cash flow model and financials with some background on this company. Before I get into the LKQ analysis, I want to just mention that there are some of these stocks that folks have commented on some of my previous videos, stocks that they want to see me do a valuation of, and I just want to share here that these are the stock tickers that I've seen in the comment section. I will get to at least some of these. I've done valuations on a few of them. Continue to comment down below if you would like to see a stock valuation on this channel. Just want to shout out that I'm aware of these. I'm going to come back and do some videos on these, so please be patient and comment down below if you'd like to see a stock valuation video for any other stocks. Now, going on to LKQ Corp, here are some just main takeaways for this company based on my analysis. First of all, it has a 16%, about 16% expected future return based on the price level today and the intrinsic value of the company. The company has been repurchasing shares very heavily over the last year and over the last couple years. The revenue and earnings have flattened over the, actually the revenue has flattened over the last year. The earnings are, kind of starting to flatten. So we might be in that part of a cycle. However, we see this as a long-term growing company. So that's giving us an opportunity because the price of the stock is leveling out or it really hasn't gone up that much lately because of this factor. We do know that they have European operations. So this is a U.S. company that started in the U.S. and expanded to Canada and U.K. and the rest of Europe. They are consolidating their European operations under one big brand, and that should do well for them looking into the future. The current price is about the target price is about 30% higher than the current price. So this thing is about 30% undervalued. And the return on invested capital is looking very good. It's growing over the last couple of years. It's been profitable long term, doesn't fluctuate between lack of profitability. And this ROIC is really healthy. We'll get to this later. It does have a dividend. It pays a dividend as of late 2021. It started that dividend. The company is actually fairly new, we'll see, celebrating their 25th year this year as a company. So they started a dividend and they grew it by 8% last year. They raised it over the first year. So let's look at what our fundamental valuation process is. Like, what are the principles, the underlying principles of our valuation? This is just a reminder for anyone who's new to watching this channel. We look at the fundamental, true intrinsic value of companies. In order to do that, there's some things here that we do. First of all, we look at per share metrics. So keep in mind that a lot of companies can grow profit and revenue and everything, and even free cash flow, but they're issuing new shares at a higher rate. And so shares outstanding is important. We want to make sure that shares outstanding are not growing and diluting current shareholders. So we always look at the per share free cash flow and profits. The next thing is that we look at free cash flow as our primary data point for the valuation of the company. The free cash flow is the money that is left over to shareholders at the end of the day. It's very close to net income, but it takes out capital expenditures, which are necessary to keep the business running and to keep the business operating at its current level or to grow. So after we know the free cash flow of the company and we project the free cash flow of the company using our best understanding of the company, we project that free cash flow into the future. We have to look at the discounted present value of that free cash flow. So we have to use a discount rate. We use a range of discount rates, sort of a range of valuation here based on our 10 to 20% return targets. We want that return on our money. We set the discount rate equivalent to that, and then we use that to get the current value, because remember, we always have to adjust from the time value of money. So we discount all the future earnings to today's present value, and that's the value of the company, the intrinsic value of the company. We also want to make sure this company is stable. It has projectable free cash flow, that it doesn't fluctuate a lot, like, okay, all of a sudden it could become unprofitable at any moment, or it's very cyclical. We want to make sure it's fundamental, it's consistent, it has healthy balance sheet, and those kind of things that all of a sudden could cause us problems. We go through a process to check the fundamentals using our pillar system. So I'll get to that later as well. Now, an overview of LKQ Corporation is that this is an auto parts distributor. They collect, refurbish, test, and sell aftermarket auto parts. They started by buying up salvage yards, like car junk yards, used collision cars, like totaled cars or old cars. They take those vehicles, they strip all the working parts that are still in those vehicles, and they put them in warehouses. They test and refurbish those parts so they can be reused by other auto users who need new parts. And the competition there is OEM parts, which are brand new, original manufacturer parts, which are very costly. They are the competition to that those OEM parts, because they can get cheaper parts because they're from cars that have already been used. They have warehouses, distribution centers, and retail stores in the US, and they've expanded to the UK and bought a lot of operations in Europe. This is an acquisitions machine. This company they started just buying salvage yards and pulling them together into one corporation, and now they're doing the same thing in Europe. The competitors are big auto parts distributors like GPC and SMP, are publicly traded companies, but any replacement parts dealer is going to be the competition for LKQ. Their market cap is over 15 billion, which is pretty large. This company has grown a lot in a short amount of time. Their current price per share is $57, which is equivalent to about a 15 to 16 trailing price to earnings ratio. They just started a dividend, as I mentioned, in 2021. It's about a 2% forward yield on the current price at $1.10 per share per year. So let's look at now the price history of the stock, just to see like where it is compared to where it's been. When we're looking at the price, we don't want to see something that's sky high. It's like at its all-time high and it's been cratering upward, because we know we're probably buying at a time where the stock might come back down to earth. And so we want to just see, I mean, a lot of times it's really good if we're looking at the price is really low, if the fundamentals of the company are good. So this is just to give context, the long-term history of the stock. Of course, you can see that R squared, the higher or closer to 1 that R squared is, the more stable the price of the company relative to its trend line there, which is, you can see an exponential dotted line represents the trend line of the price of this company. And the smoother lines are like rolling averages, so you can see what's going on there. In the last couple of years, the price has been fairly stable. It's been trending up, but kind of plateaued ever since that all-time high at $60 a share in late 2021, early 2022. So it hasn't really crossed that threshold since then. So that kind of gives me a good idea. It's like for 2 years now, it's been kind of plateaued. That might give us an opportunity based on the fundamentals of the company. I want to throw this slide in there just to share that, yeah, this company started in 1998. It's celebrating its 25th year anniversary this year. And so it's a fairly new company, but it's incorporated itself quickly. It went into public trading in 2005, I believe. And this company has really grown. Again, that $15 billion valuation, it's in the S&P 500. And they've expanded to Europe, and they have a lot of really stable operations right now. Now, here's something I just want to throw in. Always when we're evaluating companies, we want to look at the management. Who is the CEO? Who's running this company? Do we trust their management? And the CEO is Nick Zarcone. I don't know the guy. I mean, I'd have to do more research on him. I watched a few videos, and this is just a good practice when you're evaluating companies. Go look at interviews of their CEO or other major management personnel to see if they are passionate about the industry, if they know what they're talking about, if they have a direction for the company. That can just give you a gut feeling of, okay, I trust this management. So here's just a quick video for their 25th anniversary shindig internally that they released. It's available on YouTube. And let's just listen to Justin Jude, who's the president of wholesale operations in North America, talking about LKQ. It gives us a little bit of a background on the company.
Each quarter in 2023, the year of our 25th anniversary, we'd like to elaborate on a key theme or area where LKQ has made a difference. We call it the LKQ Impact. It is fitting that for Q1 theme, we focus on the notion of getting organized. Let's try to think back to 1998. Now, many of you were not even born yet or were very young, so what LKQ was trying to do was probably not very meaningful to you. But to me, and many of you who were in the salvage yards and aftermarket parts distribution business at the time, the idea of LKQ was groundbreaking. And it is safe to say that in 1998, we began to revolutionize the industry. Don Flynn, our founder, had been a senior executive at Waste Management when the idea dawned upon him to do for the salvage industry what Waste Management had done for the trash industry, namely to aggregate many of the mom and pop trash companies into a single company, and through that scale bring efficiency, improved quality processes, and value to the industry. And that's exactly what began to happen to our industry in 1998 with the formation of LKQ. When a car got into an accident in 1998 or even prior, and a shop needed a part, what options did they have? Salvage parts were not yet mainstream, and the OEMs, they were the primary option. And with the prices they charged, they knew it. And if a shop or insurance company tried to source a recycled part, shops would have to make multiple phone calls to different salvage yards to try and locate the items on the estimate. And if they were lucky enough to find a salvage yard that said they had the part, in many cases their luck ran out when the part they ordered was either not actually available or upon delivery, it wasn't even usable. Fast forward 25 years, and now the industry has better choices for parts to repair vehicles at improved cost and value. In 1998, it was not only about LKQ getting organized, but the organization of the entire salvage and alternative parts industry. And over the last 25 years, we have done our best to continuously drive our industry forward. Stay tuned. We will see you again in
Okay, so that is just I think that's a great practice to listen to videos like this. I mean, I learned a lot about their company just from that short video. How did they start? What is their main business? What value do they provide to the industry? And so that's just a little bit there of their president of wholesale operations in North America. So it's a good thing to look at the management of the company. Just take a look, scroll around YouTube, see if you can find any CNBC interviews of their CEO or anything like that when you're evaluating a company. So now let's look at their revenue starting in 2010, quarterly revenue here showing, and you can see this plateauing that I'm talking about. They've leveled off in the last couple years. Even before COVID, they started to show this leveling, but the long-term trend is clear. You can see here their 3-year annualized growth is 1%, 5-year annualized growth 8%, and their 10-year growth is 12% per year. So over the long term, this company has shown that they can grow. And even look, before COVID hit, look how steady and straight that line is. That's impressive. We've had some rocky, of course, we've had some things going on in the last year, in the last couple of years due to COVID and supply chain and everything. But that long-term trend is it looks very good to me. So that gives me a lot of confidence. Let's look at how that has played into their net income. And here we go. I mean, you can see their revenue was flat or sort of straight. But right here, since COVID started, we've had an explosion in profit. And that's because the commodity that this company has in their warehouses on their balance sheet probably exploded in value. And that's what happens. I mean, car parts became all of a sudden very valuable. People were paying a lot because people were not able to go get new cars. So what did they have to do? They had to go to these parts distributors and get new parts for their older aging cars. And average car age has been increasing a lot lately as cars they've had longer lives, and people don't want to spend money on a new car. Sometimes it's been hard to attain a new car because if they've had backups in their ability to manufacture cars, and people are on wait lists. So when cars are older now, they need these replacement parts to continually maintenance our existing cars. So what happened was the price of those parts went up as demand went up and supply. I mean, LKQ was sitting on the supply. So you can see here with the profit, it's a lot different than the revenue, even though revenue has slowed down, and you can see the leveling off in profit over the last year or so. But the 3-year annualized growth, 25%, 5-year, 19%, and the 10-year annualized growth at 17% per year in profit. That is a great trend. That's a great company right there. So let's look at free cash flow. This is the real meat and bones. I mean, profit is good, but let's look one step deeper. This takes into account their capital expenditures that they've needed to maintain the business. And yes, this has fluctuated a lot. It ramped up and then it caved back down. And a lot of times that can happen when a company goes on a capital expense a binge, or they need to deploy lots of capital to expand the business in a short amount of time, but that capital can be amortized over the future of the company. So when we're looking at this trend, let's look into the future. What's going to happen here? Eventually this decline on the 2-year average trend, and of course the 1-year trend is more jagged in the black line. The trailing 12-month 1 year is in the black, and the trailing 2-year average is in the blue or green. So that will eventually turn back upward. So you can see the historical here. Yes, it's negative over the last 3 years. The 5-year growth is 9%. 10-year growth is awesome at 16% per year. And my forecast based for my valuation that I'm going to use for this company going forward is I believe in this company. I believe these auto parts will be continue to be a necessary part for the auto market, especially as they're expanding in Europe. I think they can do really well. 14% per year in the near term is my projection, 7% in the medium term, and their terminal rate is 3%, meaning this company will be around for a long time. Sometimes if I believe a company will kind of die off in the next 20 years, I might make their terminal growth rate negative. And I always make their terminal growth rate 3% or less because a company in perpetuity cannot grow faster than the economy itself. But I think this company will grow along with the economy even in perpetuity. So let's go on and look at the shares outstanding of the company, which is really exciting because in the last year, they've declined their share count actually about 7% here. You can see over 10 years, they're down 1.2% per year. They were actually increasing their shares slowly from 2012 all the way to 2018 when they started this share repurchase program. And in the last 3 years, it's really been declining faster at over 4% per year. And again, in the last 1 year, it's like down, I think 6 or 7%. So that's a really fast declining share rate. And that's good for us. Declining share count, decreasing shares helps grow the investor stake in a company, and it improves improves their returns because they own a bigger piece of the pie, investors do. So let's move on to the per share metric. So when we adjust for the number of shares, or the rate of change of shares with these other metrics, net income in pink and free cash flow trailing 12-month in green, you can really see the increasing here. Look at this table. I have 31% per year growth, 37% per year growth, and 13% per year growth in net income. And with free cash flow, the 10-year trend is 20% per year. So that gives me a lot of confidence when I say that free cash flow is going to grow 14% per year. I mean, look at these numbers. You could say that that's really a justified rate over, for the future. I mean, this free cash flow you can really see upward bend when you take into account the number of shares, the per share rate. So going forward, this is another important thing we look at, return on invested capital. We want to see a company who knows how to deploy the cash that's coming in, the profits coming in, to make investments in their company to grow the company. And I put this line at 10% because that's anything above 10% we deem as acceptable, good. That's a good company. And the higher we can get there, the better. This company averages between 10 and 20% on their ROIC. Over time, we saw they hovered around 15% a lot. And even when they were declining, the lowest they got was around that 10% mark. And lately, it's gone skyrocketing, and that's good for us. But we like that. But I can see this over the long term being somewhere between 10 and 20%, somewhere around 15% is great. And that's why, that's a management you can trust. They know how to redeploy the capital to grow the business. And that's what you want to see. Let's last look at their balance sheet. And here is something that we always have to take into account, the balance sheet, because when we know the present value of all the future free cash flow, we have to add in, okay, well, maybe they have a lot of debt. So we have to subtract that from the current value of the company. Or maybe they have a lot of assets, so that we need to add that. That's a current value of their assets that we're buying into. So you can see here, their cash on hand, this is probably one of the things I don't like the most about this company. $340 million, that sounds like a lot, in cash on hand, but they have $2.4 billion in current liabilities. This is money due within the next 12 months. and $4.3 billion of long-term debt. So you can see here, another thing I don't like is that intangibles makes up a large portion of their total assets. So I usually subtract a lot out of the intangibles when I'm adjusting a balance sheet to right size it for my valuation methodology. So it's like intangibles is like their brand power and things like that. So it's very difficult to evaluate those things in a real sense. And I don't like trusting companies declaring their own intangible worth. So I subtract a lot from there. So you can see this. I mean, they do have $4.6 billion in total current assets. That's receivables and inventory, things that they have access to right now that are liquid that they can have access to within the next year. So 4.6 billion, that weighs up pretty good here. So it's just, I'd like to see a little bit more cash on hand, but I know what they're spending their cash on. They're repurchasing their shares. They are building their inventory. They are paying down debt. So as long as their ROIC that we saw on the last slide is pretty good, I'm okay with a little less cash on hand, but it always makes me comfortable to see this number as a bigger ratio relative to this number. And that's a pretty small gap. I mean, that's a pretty small ratio on this one. But once I have adjusted, you can see it's about just under $6 billion in net assets. However, when we adjust for things like this high intangibles, I create my own net quality assets number, which I have around 2 billion. So we've really adjusted it and made it more conservative. And that per share is about $8 per share. And remember, this is trading at $57 per share. So that just gives you an idea of where their balance sheet is contributing to the value of the company. So let's look at the business pillars. The last big thing we want to look at. This helps me understand, is the company fundamentally sound? And I have 8 main pillars and 21 sub pillars. And LKQ checks out 7 of the 8 pillars and 17 or 18 of the 21 sub pillars. I say 18 even though you see 17 here because it's like some of them are almost check marks, right? We have net income increased 4 of last 5 years. Well, it's been 3 of last 5 years. And same thing on revenue. So it's like those are almost check marks, right? So I give like 2 half check marks. So I say something like 17, 18. So it just depends on whether you want to be more conservative. But overall, that's a lot of green check marks. This company is very fundamentally sound. It's one of the better, it's on the better side. I mean, it's tough to get a lot more fundamentally sound than this. It's the debt that is the one area that they're losing one of the main check marks. And again, we just talked about that cash on hand and their debt level. And so finally, here's my valuation of LKQ. This could be a little bit confusing here, but let me explain. And sorry for the grainy snapshot. This and the screenshot on the last slide are from my personal Excel spreadsheet, which I use to evaluate all the companies. So here you can see this is for each discount rate applied, what is the intrinsic value? What is the current value of all the future free cash flow plus their adjusted net assets? So that's for each discount rate. And when we increase the discount rate, we decrease the present value of the future free cash flow. So it's like you can see if you just want a 5% return on your money, you should be paying a lot of money for this. But if you want 10% return, it's $147 a share. If you want 15% return, it's $67 a share. But this is the raw value, and this shows you the safety factor here for each of those, like the current price, like the fair value divided by the current price, like 67 divided by 57 gives you your safety factor of 1.2. But over here is where we have like our margin of safety value on all of this. So I apply a 25% margin of safety. And so we have like 2 numbers. We have the margin of safety number and we have the normal calculation. And we kind of combine these together to get our average. We have like a low and a high for each. And we can change the margin of safety, but I think 25% is pretty good given the fundamental soundness of the company and the trajectory of the price and the trajectory of their profitability. Today's price is $57 a share, and when we average together the 20% low high, 15% low high, and 10% low high, we get an average of $76 per share. So if you're okay with a 10 to 20% return on your investment, you should be willing to pay $76 a share for this company. If you need a 20% return on your money, then you should only be willing to buy the company if it gets down to the $30 to $40 range. So that's just a little bit of a breakdown of what's going on here and how I arrived at my $76 per share valuation. And so in summary, this stock is decently under the intrinsic value. Just depends on where you are on that 10 to 20% return target range. And basically, we see about a 16% future projected return if you buy the company at this price. The company has great fundamentals, it has a good management from what we can tell. So it's like, I'd say it's an A quality business. Maybe not A++, but it's very good. The balance sheet is great, but we know that it would make me a little bit more comfortable if they had more cash on hand. However, again, we know what they're spending their cash on, and it's good things. It's buying back shares at a discounted rate, and it's paying down debt, and it's expanding the business. Okay, great. They do have a dividend with about a 2% yield. It's a new dividend, so it's a little interesting because you want to see how that dynamic plays into the company's financials, but all good so far. Watch for that 8% annual increase. That's what they did last year, and I think their dividend increase should be happening at their next quarterly meeting, which that should be happening actually about next week or 2 weeks from now. So we're catching this valuation right at the end of a quarterly cycle, so they're going to have new numbers coming out soon. But watch for that dividend hike. It should be about an 8% increase. Let's see what happens. In the macro trends, the auto business, this company is right in the sweet spot, I think. Cars are getting older. The trend is very steady. People are holding on to cars longer and longer. New parts are very expensive. I mean, just think about what inflation has done to the cost of sourcing new parts for cars, OEM parts. So this business provides that extra competition. It provides that extra buffer for customers. So they really have that competitive factor and pricing power. I think the macro trend is working really well for LKQ, and we'll see how that continues into the future. They have growing operations in Europe, so this is a diverse geography. I mean, this company has started in US, but has expanded. So now they have exposure to the European market, and I think about half of their revenues now come from outside the US. So if you think, hey, there might be trouble in the US or there might be trouble in Europe, it's like this company can diversify. It balances itself out. So maybe you think that's a bad thing. Maybe you think that's a good thing. I think overall that's good because it's not concentrated just in the US economy. So overall, I give this company, I give LKQ a value rating of 7 out of 10. It's about in the top 20 percentile of companies I've evaluated. It's not perfect on fundamentals, but it's really, really good. It's not the most undervalued stock that I've seen recently, but it is up there. I mean, it's up in that good range where if you're okay with a 15% return, and especially if you're okay with a 10% return, and you want a company that the price doesn't fluctuate like terribly a lot, it's a pretty consistent company. And if you're okay with a company if you want a company that pays a small dividend, a growing dividend, hopefully, this might be a company just for you. So I would give this company a thumbs up if you're looking for those kind of things. And I would keep your eye on this company. I don't personally own it right now in my portfolio, but I'm looking at it closely. It's up there. It's on my short list of like the watch list of stocks I'm looking to see. I mean, I just discovered this company recently, so it's a pretty good find for something I just found. And I'm going to keep watching this. I have to do more digging. I have to be more comfortable to buy it. And hopefully we could get a break where the price could decline a little bit more, or we get better financials. So let's keep watching this company. That's my breakdown of LKQ Corp. And I hope that this analysis really helped you to understand the company better and understand its intrinsic value. Thank you for watching this stock valuation video of LKQ. Again, if you would like me to evaluate any other stocks and share a video like this one, please comment that down below. Thanks for watching. Leave a like. I'll see you on the next video. Thank you, and stay wise.